All right, so a couple of days ago, I shared this tweet out on my Twitter page, which is at Emmanuel Finance, if you don't follow me already. But it got quite a good reception. But this is what it says, right? It's a key message here. It says, Hims, you can really begin to appreciate how the holders of Amazon felt back in 2001 when they watched the stock drop from $110 to $6. Meanwhile, with each passing quarter, every financial and fundamental metrics of the business was essentially improving, and it was improving fast. And I put the quote, patience is bitter, but the fruits are sweet. Okay. Now, to put this further into context, let's take a look at Amazon's revenue, right? So in 1999, Amazon generated $609 million, which is crazy when you think about it. Considering now they're making like $100 billion every quarter. Let's just take it back to 1998. All right. So at that time, how old was I? I was about 7 or 8. So when I was 8 years old, Amazon generated $609 million for the year. The following year, they more than doubled their revenue. Okay. In 1999, they generated $1.64 billion. Okay. In 2000, they upped it again and they generated $2.76 billion. And in 2001, they generated $3.12 billion. So from 1999, okay, they pretty much doubled their annual revenue within the space of 24 months, okay? So you look at this and you're like, my goodness, this company is fast growing. I mean, they're doubling at almost 100% annually, which is crazy. And if you look at the stock, how did the stock react during this period? Absolutely tanked. Okay, so this was going back December the 14th. Actually, hold on. Yeah, so the 10th of December 1999. Let's say you've seen the Q3 results and you're like, wow, this company has pretty much doubled their revenue. So from 1998 to 1999, they more than doubled their revenue, right? This is a great company. You know what? I like Amazon. They've doubled their revenue in pretty much a year. I'm going to buy, right? So you bought at $113 or $110 was your buy price. And then for the next 2 years, okay, 2 years, the stock collapsed. Whilst every quarter, they were reporting great revenues. I mean, you've seen the numbers annually. They were doing incredible. But the stock tanked. Let's do the measurements. So it's tanked from there all the way 2001. So from 1999 throughout the whole year 2000, pretty much it collapsed and it got to it was down 94%. Hold on, let me pull that up. Let me pull that back up for you guys. 1 second. It's not like Trading View. So yeah, it tanked 94%, 94.37%. It was down by. If you bought in when you saw that they just doubled their revenue, you'll be down 94% on your position. Madness, right? So 1999 you bought, and then you wouldn't actually start to see it pick up until, look, even through to 2000, it pretty much was downtrending and consolidated even into 2002. So again, a full year of consolidation and even trending lower, if you will. And then it only started to pick back up again in 2002. It started to rise. And then you know the history of Amazon. The rest is history, okay? So think about it. You bought in because you've just seen this company has just doubled their revenue right here. And you're in the red for 3 years, essentially, until you start to make a move. Insane, all right? So that's what I meant by this tweet, that you can really begin to appreciate how the holders of Amazon during that time felt. And the reason why I associated this to Hims, because yesterday Hims announced that they're going to be offering their health and wellness products on Amazon, in Amazon stores, which is going to boost our online revenue. Okay, so it says today announced it will start offering its products in Amazon stores to increase accessibility of Hims and Hers supplements, sexual health and wellness products, and health caring offerings, including a few product bundles exclusively available through the new official Hims and Hers store on Amazon.com. Great news, right? Wrong, because if you look at the market, according to this market, that's horrible news. How dare you? How dare you say you want to increase your online revenue? And we're down what? We're down 7.5% just today. Okay. So even on that news, we had that initial spike. It closed red on that news. and we are down even lower. So I've been taking advantage and I've been buying more HIMs. Okay, if you look at this company's metrics, this was an earnings review update that I share with my Discord. It's a couple of pages long with more of my thoughts and everything like that, but let's just take a look at the metrics. Okay, so HIMs from Q1, they had 391,000 subscribers. Q2, we saw a 15% increase to 453,000 subscribers, and in Q3 we saw an even greater increase quarter over quarter of 21.6%, and we added 551,000 subscribers. The same thing with our net orders. We saw a 23.15% increase from the prior quarter, so sequentially, essentially. And also, if you look at our online revenue, it was up 23% sequentially. I mean, you've got other growth companies that are producing 23% year over year. I mean, you've got HIMs growing at 23% quarter over quarter. And the only red flag that I kind of pinpointed out in HIMs' Q3 earnings was our marketing. So our marketing saw a 37% increase, but our revenue only saw a 23% increase. Okay, so you want to kind of keep an eye on that, because you want to keep a close eye on how effective management are at allocating capital. So if we're spending a lot more on marketing, but we're not seeing that turnaround in our top line, that's something you really want to keep an eye on. Okay, so yeah, that was HIMs. Now, the next stock that I've been buying has been Opendoor. Okay, so shout outs to Mike Delpreet. He's a quality analyst and he keeps an eye on the iBuyer market. Now, in Q2, when I started buying Opendoor, I shared this research with you guys on my channel. You can check some of my old Opendoor videos out. iBuying, for the first time in history, took up 1% of all US homes purchases for the first time. Okay, so this was reported by Zillow. Now, Zillow, of course, are out of the iBuying race. They're not going to really be covering it, but Mike Delpreet is. And guess what? In Q3, that 1% increase now increased to 1.6% of all homes purchased in the US. That's huge, okay? That is huge. Just between quarters, we're now responsible for 1.6 of a $1.9 trillion industry. Guys, do not sleep on iBuying, okay? And this 1.6% is really just the beginning. This shows there's a lot of demand for this service. And companies like Opendoor and OfferPad are going to take the lion's share of this growing market, and they're going to have a monopoly on this market. Now, before we get into Opendoor's margins, which has been improving, by the way, I quickly want to share what I shared with my Discord a couple of days ago. So I believe with iBuying, we are at the infancy stage of our S-curve, okay? And at some point with demand, we're going to hit that inflection point or that tipping point where it goes from infancy to expansion, and it's just going to rocket. Okay, so think about this. We went from 1% of all US home sales in Q2 to 1.6%. Okay, now Zillow has dropped out of iBuying. That's going to probably skew Q4, but going into Q1, Q2, we are approaching this expansion phase for iBuying. And to be honest, you really want to be buying during this infancy stage before we experience this expansion. And that's been evident in Opendoor's revenue. Look at the revenue growth, okay? Look at that growth quarter over quarter, okay? So that was almost a 96% growth from Q2 and Q3. Insane. All the while, our gross profit is increasing and our operating income is also heading in the right direction. At what point in the S-curve do you think it makes sense to invest? I believe in this infancy stage. And if you look at Opendoor, they've been in this business for over 7 years. So typically within the infancy's timeline, that's where companies make mistakes, they mess up. Hence you had Zillow Offers, which collapsed because they've only been doing iBuying for 2 years versus Opendoor's 7-year experience in this game, and even OfferPad, which has over 6 years experience. So they've already done the hard work, during this infancy stages. They understand different market cycles. Eric started investing in property back in 2008 when the market crashed. So him and Ian Wong, who's also the other co-founder, they've pretty much been able to build their pricing models based on their experience of the worst real estate crash in history. All right, and it's clearly proven to work. Let's dive a little bit deeper into this research report by Mike, and I will link this report in the description below if you want to take a look at it yourself. So look at this. Both Opendoor and Zillow scaled their iBuying operations tremendously in Q3, but while Zillow's business spectacularly imploded, Opendoor demonstrated critical economies of scale. As it grows, its net loss per home is improving quarter after quarter. Look at the improvement. It's in the numbers. It's in the numbers, all right? These charts show net profit loss based on simple maths. So that's total net profit loss for the business divided by the number of houses sold, excluding stock-based compensation. The result is a benchmark of business model efficiency, okay? So while Opendoor and OfferPad improved their net profit loss in 2001, benefiting from record home price appreciation, Zillow's just got worse. So, and that's excluding the $304 million inventory write down. Another reason Zillow offers just wasn't working out, okay? And if you take a look at margins, as it scales, guys, as it scales, Opendoor's revenue and gross profits are increasing faster than fixed and variable costs. That's a positive sign and something critically important to Opendoor's growth and profitability narrative. So with Opendoor, oh, it's actually turned green. We tested this support level. Okay, so for me personally, anytime we test this support level here at $20.39, I am buying. Okay, and if we drop below it, I am continuing to buy. My average in Opendoor is now $19.07, but I am loading the boats. I am loading the boats on HIMS, and also I'm loading the boat on Opendoor. So drop your comments in the section below to let me know what you guys are buying. If you want access to my full research notes for HIMS, for Opendoor, I've done a full review on Opendoor right now. Celsius, there's a ton of research that I share with my Discord members, going back to even PayPal, my thoughts on PayPal, new recent investment, even Zillow research that I did, Opendoor, and we also share more research with each other inside the Discord chat. I'm gonna give a shout out to Zyfin, who's based in Malaysia and Singapore. He gave some incredible research with regards to Alibaba today, which we had Alibaba's earnings come out. So he gave great perspective from his point of view, which is absolutely valuable. And look, this Discord is not just about, we're not pinging out buying and selling. We're not pinging out none of that. We're all sharing each other's research. We're learning and we're growing and building our wealth together. So if you want to be a part of that, my Patreon link is in the description below. And thank you so much for watching, and I'll catch you in the next one. Peace.